Good morning, members. Welcome to this meeting of the Joint Pension Sub and Pension Board. Can we have the surrounding apologies for the Pension Subcommittee, please, Claire?
Thank you, Chair. There's been a couple of changes since the papers were issued. Elaine Murray's come off the Pension Sub, and there's been a change in representation from the Conservative group. John Charters replacing Ian Carruthers. So, putting all that in mind, we have 6 members present and 4 currently not present, although I believe 2 of them are in the building.
And the surrounding apologies for the Pension Board. Apology for Jan Andrews. That's great.
Okay, thank you. 4 board members present.
Okay. Do any members of the Pension Subcommittee have a declaration of interest? Nope. And do any member of the Pension Board have a declaration of interest? Nope. That's great. Item number 5, the minutes of the last meeting. Was there any issues that anybody had? I'm quite happy to move them. Great, thanks very much. Turning now to agenda item 6 on the REMIT, the Pension Subcommittee and Pension Board. This came about as a sort of issue from the last meeting, and we brought the agenda item as quickly as possible. Is there anything you want to add to the report, Paul?
Just as you say, there was a bit of discussion at the last meeting. I think that discussion was largely as a result of the decision to treat the last meeting as a meeting of the subcommittee rather as a joint meeting. That was my decision, but to be honest, it wasn't really a decision, it was more of an oversight. It could easily have been a joint meeting. The intention was to run it exactly the same as the joint meetings in terms of the Pensions Board members were also invited. They were expected as usual to take full part in the discussion and the debate, but because the meeting was specifically to look at an investment decision, the decision making is specifically the role of the Pension Subcommittee. So there was no reason why it couldn't have been a joint meeting. It was nothing inappropriate about it being a single meeting, but it could easily have been a joint meeting. And I think going forward, unless there's a particular reason the subcommittee wished to meet individually or separately, we would treat all meetings in that manner as a joint meeting formally.
Okay, thanks very much for that, Paul. Any member have any questions? No, we're quite happy to move to the recommendation. It's just to note the background as to why the board was established and the constitution of both the committee and the board. We're happy to agree. Okay. The next item of business is item number 7, the external audit plan for 2018-19, and we have John Boyd here to speak to the report.
Oh. We were anticipating him being here. He doesn't need to be here.
Okay.
Has he been seen at all this morning?
No, that's fine. Is there anything you want to add to the report?
No, I think we were expecting the external auditors to be represented. However, they're not here now. That's fine. The external audit plan is pretty much a standard plan. The risk assessment that's been undertaken by the external auditors has not identified any specific issues that they see as being a higher risk in relation to the Dumfries and Galloway Fund. If members recall, last year's external audit report did not identify any significant issues. There were no action plan items for the members or for officers or members to take forward. That's largely reflected in the plan for the new financial year, so we're not anticipating any specific risk issues to be identified by the external auditors. There's nothing reflected in the plan in that sense, and members are asked to note the details of that plan that's been brought forward.
Thanks so much for that, Paul. Is there any questions from members? Graham?
Thank you, Chair. Apologies for being a couple of minutes late. We were engrossed in conversation. And also, Matthew Roney is an apology because he's in hospital having a knee operation. Now, my question is, and it's just for information, on page 31, there's a thing that says pooled costs, £2,100. Could somebody explain to me what pooled costs are? Has somebody been swimming or,
Basically, it's part of costs that are incurred on behalf of auditors at a national level, and each audit that they undertake absorbs a share of those pooled or joint costs.
just proves I've looked at the papers.
Any other questions? Nope. Yeah,
Obviously, the pensions manager is really important, making sure that the audit risk and the audit goes forward, and any risks that come forward, they are to inform us as a pensions board and subcommittee of those particular things. Can I just ask who the pensions manager is?
The committee effectively is the manager of the pension fund. In terms of the officer role, it's largely been Andy up to now. Moving forward, Karen's going to take on more of that role. So we've got good arrangements in place for managing both the audit, the final accounts process and the subsequent audit.
any further questions? Nope. Okay, I have to move to the recommendations, and that is to note, and I think that we have commented on the external audit plan for 2018-19. Happy with that? Agenda item 8 is the investment strategy review. Is there anything you want to add to the report, Paul? Karen?
Thank you, Chair. I suppose just to give a sort of brief overview of the report, it's mainly to provide an update on progress in the implementation of the revised investment strategy, just to highlight that really good progress has been made and it is now almost complete. As planned, we've had the UK equities transfer to the Diversified Growth Fund as an interim measure, and we've now transferred £60 million of that funding across, following the February meeting where we appointed BlackRock as the alternative income fund manager. We're now working with them to look at getting the money invested. The initial indication is that will take place over the next 12 months. Hopefully starting about June time. Obviously, the committee also agreed to an allocation to the UK property. However, due to uncertainties at the moment, we've been advised to try and delay that until later in the year. So there's been no update in respect of that. The transfer from UK gilts to bonds is now complete, and obviously we've got the item later on in the agenda to consider the transfer to a multi-factor passive investment fund. So basically we are almost there and good progress is being made, and hopefully we'll get another step forward later on in the agenda, but happy to take any questions.
Any questions from members? Archie?
I think it comes back to this risk side of things, and probably, hopefully, June puts a wee bit of warning on me as to this investment going forward. I mean, what sort of steps are we taking to make sure that it will be June rather than probably, hopefully?
Well, obviously, to an extent, we're in BlackRock's hands with this and going according to their timescales. And I think, Paul will correct me if I'm wrong here, that June's the next opening to transfer into the fund. Is that correct?
Yeah. Sorry. Periodically, they have what's called closings, when they gather all the commitments together and then start deploying all of that money at once. And, they have said that their next one will be in June. We don't see any reason why they'd delay that. That is only the start of the process of getting the money in. So there'll be an initial payment then, and then actually deploying that fully might be 1 to 2 years, in fact, across all of the asset classes. But we don't see why they would want to push that past June. So we've asked for all the documentation, and we're working to that deadline in terms of starting the process of getting commitments across.
Malcolm?
Thank you, Chair. You mentioned uncertainty. There's obviously an awful lot going on in markets at the minute, and I just wondered, we've made this decision, we've reviewed the strategy, and we came up with what I think is quite a good decision here, or what we're doing, but I wondered if there's when we were subsequently reviewing it, because I think events over the next 12 to 18 months could change quite dramatically.
I mean, I think when we went through the strategy review, the kind of modelling or projections we were doing were quite long term. We were saying what kind of level of investment risk do we want against the contributions to keep the scheme. sort of well-funded or fully funded. So it is, the strategy is being set on with a pretty long-term time horizon. Now, that doesn't mean to say we can't review certain aspects of it. And one bit that we have reviewed pretty immediately was, do we want to start putting money into property ahead of a potential bad Brexit when you could see a big markdown in prices? And the view was to defer the timing of that. So, I mean, in a way, the practice would be to come back and review the long-term strategy each time you do an actuarial valuation. So every 3 years you must satisfy yourself that you're happy or not happy with the strategy. It doesn't mean that if there's some big event in the interim, you can't have the discussion of whether you think there needs to be any changes. But we're not trying to change it on the basis, for example, of what happens at the end of March. I don't see that triggering a review of all the decisions we've made. So we kind of keep it in track. We would formally review it, I think, in conjunction with the next valuation, as a minimum.
So we'll be reviewing it at the actuarial review, which is fine, but all I'm saying is it's probably wise to keep a weather eye on events, which basically is exactly what you said, so that's fine.
I suppose the next 12 to 18 days, never mind the next 12 to 18 months, will be key. At least someone has. Henry?
Yeah, thanks, Chair. Paul, it's just to following up on that, in the allocation to UK property, you touched on it slightly there about delaying any investment until later in the year. I was suggesting that we'll delay that investment to later in the year and perhaps make a decision pending on what the market situation is with the property, or are we saying we're going to make that investment later in the year?
The intention would be to start implementing that later in the year. The reason for the delay is that if we look back at what happened to markets after the referendum in 2016, which was the last time it had a kind of negative EU shock, as it were, property values were marked down really quite significantly on one day. Values were marked down by about 10%, and all the surveyors said, we don't know what's going to happen to this market, so to take a conservative approach, we're going to write down asset values. Now, in time, buyers came back into the market and those prices recovered. But I think there is a risk here that we start buying units in property funds at the current net asset value, and then in a month's time, they get marked down 10%, and we're left looking completely ridiculous for the timing of that purchase. So it's the biggest short-term risk to doing something and immediately regretting the timing. So we will get through March somehow, and we will know where we are in the summer, and assuming prices are then reflecting the new world, whatever that is, then we'd be likely to have some confidence to start buying units, where they become available. But I was just really nervous that the short-term timing could have proved really disastrous on that particular asset class.
David?
Just following on from that, if that is likely to happen, does it not reflect on the current property allocations that we've got? And would it not be wise to think about doing something with those and benefiting, perhaps?
I'm not saying it's likely to happen. I don't know what's likely in terms of sort of good Brexit or bad Brexit. But what we're saying is if things go badly between now and the end of March, and I don't know what the probability of that is a sector that would suffer. So, on balance, maybe we get some kind of deal that the market's put up with. So I'm not saying that's the most likely outcome, but it is an outcome that we would really regret having put money in initially. So, I mean, realistically, we wouldn't be looking to come out of property because we think that's going to happen and then go back in again. To do that, we'd need to have a very high expectation that property values would be marked down. I'm saying that there is a risk that there would be.
Are they likely to be marked up then?
They're unlikely to be marked up in the same way. I mean, it might. it would improve general sentiment in the property market. So that sort of balance between buyers and sellers. But I don't think you would get surveyors going into these pooled property funds and just as a knee-jerk marking up the value of all properties in a step change just because it was seen as quite a good outcome for the market. But they did mark them down in a step change when they didn't know what the impact of the negative vote would be. So it will be positive for the market, and but you won't see the big price change that you would in terms of them being marked down, is my view.
So I'm thinking then that there'd be no risk in coming out of the market temporarily and going back into it if there wasn't a big downward spiral. But if there was a big downward spiral, then there would be a great benefit because we'd be able to profit from that.
But the cost of coming in and out of property is huge because the bid-offer spreads on these funds can be 6 or 7% because the costs of buying property, not only have you got 4% stamp duty, but you've got agents' fees, and so the coming out of property and going back in will cost you something like 6 or 7%. So it's hugely costly to transact in. That's the problem.
Any further questions? In that case, we'll turn to recommendations. Are members happy to note the current position and implementation of the agreed revised investment strategy? Yep. And 2.2, to note the suitable multi-factor passive investment fund that has been identified and that members will continue to receive further information on this fund as part of the fund manager update. Happy to note. Turning to agenda item 9 is the annual training plan and record of training. Anything to add to the report? Karen?
Yeah, obviously, this report for members is a sort of their training regular update. It's just to highlight that the improvements to the training record that were agreed at the November committee meeting have now been incorporated into the plan, and just to highlight that there has been some training opportunities identified in October this year, and we're hoping to bring further information on those back to the next meeting.
Archie?
Just an update, Chair, on the Appendix 2. I thought I had to do my pension regulator training before I actually came into the last meeting, so on the 19th of February I completed that training before the pension sub.
I've started that training and I'm excited to finish it. Any other members want to raise a question? Nope. So we're happy to note the revised training plan in Appendix 1 following the previous meeting of the subcommittee. 2.2 to note the progress to date in the record of training Appendix 2 and the process for updating that record. Yep. And happy to note that the Pensions Regulator Public Service Toolkit training is available and the background information needs to be completed. Okay. Agenda item 10, I don't have any other business. Agenda item 11 is the Local Government Scotland Act 1973. Is the committee happy to consider adoption of resolution